Today, we're diving into one of my favorite strategies, the wheel strategy, which is a powerful options trading strategy that can help you supplement your current income or retire early, making $5,000 or even $10,000 depending on the capital you can allocate. We will be using one of my favorite stocks, Sofi, as an example, which is great not only for large accounts, but if you have a small account or are just starting out. Hi, my name is Gautam, and on this channel, I talk about the stock market and achieving financial freedom with the power of options trading. So if you enjoy content that can help you retire early and achieve financial freedom, don't forget to hit that like button, subscribe to my channel, and share this video with your friends and family. Also, if you are new to the options world or are simply looking for one-on-one guidance to help you shortcut years of trial and error and avoid costly mistakes, click on the coaching link below and I'll be honored to help you out. Now, let's dive in and see what's been happening with SoFi. I'm going to take you to this article on Yahoo Finance that mentions SoFi sees meaningful Q2 growth ahead, shares rise. Shares of SoFi Technologies rose 5.7% after Chief Financial Officer Les Lapointe delivered an optimistic outlook during his appearance at William Blair's 45th Annual Growth Stock Conference. Investors responded positively to management's strong positioning for future growth, with Lapointe emphasizing that momentum will continue to build in the coming months. In the second quarter, we expect another meaningful increase in volume and revenue, citing the company's lending platform business as a key driver. The capital light channel moves originated loans to institutional buyers within days, enabling SoFi to scale without expanding its balance sheet or taking additional credit risk. The CFO also pointed to the strength of the company's diversified revenue model and its ability to scale profitability. Our strong Q1 in terms of overall financial performance has allowed us to increase our outlook for the remainder of the year across all key measures. SoFi now expects 2025 adjusted net revenue of up to $3.3 billion and adjusted EBITDA as much as $895 billion and earnings per share between 29 cents and 28 cents. We've also increased our medium-term revenue guidance covering the period of 2023 all the way to 2026 to be now above 25% annualized growth. The firm continues to benefit from increased product adoption across its platform, driven by cross-selling and subscription-based services. For new subscribers to the program, 90% of them were existing members on the platform, and a third of those took out additional product within 30 days. Demand remains strong across consumer lending, financial services, and technology infrastructure. SoFi sees particular tailwinds from resumed student loan payments and interest normalization, both of which could lift refinancing volumes and home lending. Taking a note of SoFi CFO's positive commentary, William Blair analyst Andrew Jeffrey reiterated his outperform rating on SoFi, emphasizing accelerating volume through SoFi's lending platform and improving earnings visibility as valuation catalysts. The stock continues to trade at a discount in the fintech sector, with analysts expecting more than 30% upside potential over the next year. So as you can see from that article, the future seems to be pretty solid for SoFi. If we look at the current fundamentals on Yahoo Finance, SoFi has been pretty solid, beating its earnings per share quarter over quarter. Revenue has been increasing steadily as shown by these blue bars, and so have the earnings. We have about 20 analysts covering the SoFi stock. So it's a mix of hold, buy, and strong buy, as you can see for the most part. It's currently trading at 14.24, which is pretty close to the analyst price target of 14.12. Obviously, SoFi had a jump of almost 5% this week with the CFO comments, as we pointed out earlier. Now that we've gone over why I like SoFi and its fundamentals, let's talk about the wheel strategy and see what it entails. So the wheel strategy is an options trading strategy that involves selling cash-secured put options to potentially acquire stock at a discounted price and then selling covered calls against those shares to generate income and then potentially exit the position and restart the wheel strategy. This strategy allows you to profit in three ways. First, by making premium on selling put options, then by collecting premium on selling covered calls, and finally profiting from the stock price appreciation when your shares are called away. Next, let's go over each of the steps of the wheel strategy in detail. The first step in the wheel strategy is to sell cash-secured put options on your favorite stock. A cash-secured put is an option strategy where you sell put options at a specified strike price within a certain time frame or an expiration date. when selling cash secured put options, you will be required to put collateral to execute the trade, hence the term cash secured. You'll collect a premium upfront for executing the trade, which provides you immediate income and gets the wheel strategy started. For step 2, if the stock price drops below the sold strike price at expiration or before and you get assigned, you'll be required to buy the stock at the sold put strike price, no matter what the current price of the stock is at that point. This might seem like a downside, but you're potentially acquiring the stock at a discount price from the time that you originally sold the put while collecting premiums from the put sold. For step 3, assuming you got assigned and now own the shares, you can start selling covered calls on those shares and collecting additional premium from those covered calls. When selling covered calls, if the stock price remains below the sold strike price at expiration, you get to keep the stock and the premium. You can then sell additional covered calls and collect additional premium. If the stock price rises above the sold strike price of the covered call and your call options are exercised, you'll sell the stock at that strike price while keeping the original premium collected and also making additional profit from the stock price appreciation. And last but not least, after getting rid of your shares for a profit, you can restart the wheel strategy and start generating additional income. Now, a lot of you have reached out to me on YouTube asking about the risk or the downsides of the wheel strategy. So here are some risk management tips that I've put together. First, when selling put options, if the stock price drops much lower than your sold strike price at expiration and you are not ready to accept assignment, just roll your position down and out to a further date to avoid assignment. I actually have a video dedicated to rolling, so click on the link above to check it out. Second, only run the wheel strategy on stocks that have strong fundamentals and future growth potential. Do not run the wheel strategy on meme stocks just to collect a higher premium, because that guarantees that you're going to be bag holding for a while. And last but not least, when selling covered calls, sell them at a strike price that you're comfortable getting rid of your shares because your profit is capped at that strike price. Next, let's go over to Thinkorswim and see how we can generate $5,000 a month on Sofi running the wheel strategy. But before we do that, let me show you that I put my money where my mouth is. So let's check out this position that I opened in Sofi last week. And again, my goal on Sofi is to actually get assigned on these shares at the strike price that I sold this put option. So let's check out what I did. So I'm recording this video on Sunday, June 8th, but last week on June 3rd, I sold 10 Sofi put options at a strike price of 12.5, expiring July 3rd, which is basically 30 days out. And for that, I collected a premium of 33 cents or $33 per options contract, giving me a total premium of $330. If we do some math right here, and I do 330 divided by 12,500, which is basically 10 option contracts. Since one options contract is $1,250, 10 options contracts equate to 12,500. So I'm going to do $330, which I receive for selling these put options 30 days out, dividing it by 12,500. That gives me a return of 2.64%. Now, I generally like to target monthly returns between the 3 to 5% range. So let's see how we can supercharge these returns to help you make more than 3% doing the wheel strategy on Sofi. So I have the 3-month Sofi chart pulled up here in Thinkorswim. And as you can see, I have the Bollinger Band set up, the yellow being the top band, the green being the middle band, and the pink line here denominating the bottom of the Bollinger Bands. And for those of you who are not familiar with the Bollinger Bands are a technical analysis tool, and 95% of the times, the stock continues to trade within the Bollinger Bands. There are instances where the stock will deviate or actually break out of the Bollinger Band, but it generally comes back inside pretty quickly. As you can see on April 29th, Sofi jumped out of the Bollinger Band right here, but quickly reverted back under the Bollinger Band. And then we had another instance here on May 14th, where Sofi touched a high of 1478 and quickly reverted back under the Bollinger Band. And if we look at where it's at right now, it's currently at the top of its Bollinger Band as of Friday, June 6th. Again, I'm recording this on Sunday, June the 8th, which is after hours. So Sofi ended the day on Friday, June 6th at 1424. Now, looking at the chart and where I'd be comfortable owning Sofi, I'm going to shoot for this very obvious middle of the Bollinger Band, which is actually a strike price of 1349. So let's pull over the options chain and see how much premium we can collect targeting that strike price of 1350. So at present, the 1350 strike price is offering us a premium of 15 cents or $15 per options contract. So let's do some math here and see how much of a monthly return that equates out to. So $15 per options contract, and one contract is going to cost us 1350. So 15 divided by 1350 is 0.01, and we times it by 4 weeks for a month and times it by 100 because one options contract lets you control 100 shares. So that's a return of 4.44%. Again, this tells you that selling options weekly is obviously more lucrative than selling monthly options. But again, if you're a busy professional that's doing this on the side, it's probably worth it for you or easier to sell options on a monthly basis because that requires less management than selling weekly options and managing them weekly. So again, it's totally dependent on your personal situation and what works better for you. So I'm going to go ahead with this option selection right here, click on the 15, and I am going to go ahead and sell 36 contracts of the 13.5 strike price at a cost of $15, or actually receiving a premium of $15 per options contract. And if I hit review, that gives me a premium of $540. Now, I'm not counting the commissions because a lot of people use Robinhood, which is no commissions. Now, if we do 540 times 4 weeks, because we're doing this, every week, we're going to collect a premium of $2,160 by selling these put options. So now let's assume we sell put options for 4 weeks and we finally get assigned at a strike price of 1350. So let's look at the options chain. I'm looking at the same options chain, which is about a week out, June 13 options chain. And let's check out some of these deltas right here. We have a delta of 16, which is offering us a premium of just 9 cents or $9. I actually like this delta of 28. We don't have a delta of 20, which I generally like. So we have a delta of 28, and that's offering us a premium of $18. So if I do some math here, $18 times 36 contracts, so that's $648 that we're going to collect each week. Now, if I do $648 times 4 weeks, I'm going to end up collecting $25.92. So once you're done collecting that premium of $25.92, let's assume that you sell covered calls one additional week and your call options get exercised. That means you agree to give up your shares at a strike price of $15. So in that case, you would make additional profit from the stock price appreciation, which is the difference between the $15, the sold strike price, and the price that you acquired the shares at 1350. Now, I'm a numbers guy and I like to put everything on a spreadsheet to see how it makes sense. So I put the whole wheel strategy for Sofi in Excel, and looking at the first step, we said we're going to sell cash secured puts at a strike price of 1350, a delta of 23. We sold 36 contracts that requires a collateral of 48,600, which is basically 1350 per options contract times 36 contracts. That gave us a premium of $540 per week, resulting in a monthly income of $2160. And for the second step, once we were assigned, we said that we would sell covered calls at a delta of 28, which at the time is offering us a premium of $18 per options contract, resulting in a weekly premium of $648 or monthly income of $25.92. Now, we said that at the time that our cover calls are exercised, that we would make additional profit, which is the difference between the price that we acquired the shares at, 1350, and the price that we sold them at. So that gives us $1.05, which is 15 minus 13.5, times the 3,600 shares, which is basically 36 contracts times 100 shares per options contract. So 3,600 shares times 1.5 results in an additional stock price appreciation profit of $5,400. Now, if we add all three of these together, the income from the sold puts plus the income from the covered calls and the additional profit, we end up with the total profit of $10,152. And all I did here was divided by 2, and that would result in a monthly income of about $5,000 and a 10% monthly return, which if we annualize that, 10 times 12 is 120%, which is fantastic. So that's it for this video. If you enjoyed this video and learned anything useful, please give it a thumbs up, subscribe to my channel, and leave your comments below with any thoughts or feedback. If you'd like one-on-one coaching directly with me, click on the first link in the description below, and I'd love to help you out.